You're probably holding a piece of ARM-powered tech right now. Your phone, maybe your tablet.
Or think about your car, even smart home stuff.
Exactly. These
Yeah.
things are humming along, and a lot of that internal design work, that ingenuity, comes from ARM holdings.
It really is the fundamental architecture. It underpins, so much of our modern digital world.
Right.
And for this deep dive, we've gone through this pretty comprehensive report. ARM Stock Deep Research. It's dated May 5th, 2025. We're pulling out the essential insights on ARM Holdings. That's NASDAQ ticker ARM.
Yeah, and our mission here is pretty straightforward. We want to give you a clear, thorough understanding of ARM, what their business is, how their financials look, where they stand in the market, and what the future might hold.
Basically extracting the crucial stuff.
So you can get up to speed quickly, properly, without getting totally bogged down.
And if you want to dig deeper yourself, all the source material, it's listed right there in the description.
Okay, so to really get ARM, where do we even begin?
Well, let's start with what they actually do, because they aren't making the chips themselves, are they?
No, that's the key thing, right? They design and license semiconductor IP.
Intellectual property. Think of it like the blueprints, the core designs for processors.
Right, for CPUs.
Yeah, CPUs, focusing on performance, low cost, and crucially, energy efficiency. That's kind of their calling card.
So they're the architects. They provide the plans, others build the chips.
Exactly. And this model, this asset-light IP licensing model, it means they don't have the massive costs of building and running chip factories or fabs.
Which lets them focus their money where?
Research and development, R&D. It lets them pour resources into designing better, faster, more efficient cores, constantly pushing the tech forward.
Okay, but the research mentions something, well, potentially really interesting, a possible strategic shift.
Ah, yes. The idea that ARM might be contemplating actually producing its own ARM-branded chips, specifically for the data center market.
Wow, that sounds like a huge departure from their usual playbook.
It would be fundamental. I mean, shifting from just licensing IP to actually making and selling chips, that's big.
And the data center market is massive.
Huge. Projected $123.4 billion by 2030. So the potential upside is, well, obviously attractive.
But I mean, isn't that a massive gamble, competing with their own customers? What's the thinking there?
That's the million-dollar question, isn't it? Or maybe $1 billion.
Huh, probably.
Look, the opportunity's there,
Mm-hmm.
but the challenges? Massive capital expenditure for fabs, the whole complexity of manufacturing supply chains, stuff ARM hasn't traditionally done.
And they'd be going head-to-head with giants.
Hey.
NVIDIA, maybe even Apple down the line in servers.
Exactly. It could really strain those crucial relationships they have with their licensees.
Yeah.
It's a definite risk, something to watch.
Okay, yeah, definitely something to keep an eye on. So back to how they currently make money. What are the main streams?
Primarily two things: licensing fees and royalties.
Licensing fees, that's the upfront payment, right? To get access to the designs.
Correct. Chip companies, OEMs, the guys building the phones, laptops, whatever they pay ARM for the right to use their IP and their chip designs.
And those fees grew a lot recently.
Yeah, FYE 24 saw a big jump, 43% up to $1.43 billion. That was like 44% of their total revenue.
Why such a big increase?
Driven by things like long-term deals. You'd have a thing called ARM Total Access. Also, lots of R&D happening in AI chips by their customers and just signing up new customers too.
Okay. And Q3 of FYE 25, still growing.
Yep, $403 million in license and other revenue,
Yeah.
up 14% year over year. So still solid growth there.
All right. And the other big stream is royalties, the ongoing payments.
Yes, this is critical. Recurring revenue. Every time a partner ships a chip with ARM tech inside, ARM gets a small cut, usually estimated around 1 to 2% of the chip's selling price.
And that grew too.
It did. 8% growth in FYE 24 hit $1.8 billion. That was actually the larger slice, 56% of total revenue.
What drove that growth?
Partly a general recovery in the semiconductor industry, but also, really importantly, the adoption of their newer ARM v9 architecture.
Ah, ARM v9. Why is that specific architecture so key for royalties?
This is where it gets clever.
Mm-hmm.
Architectural leverage. See, newer designs like ARM v9, they command higher royalty rates than the older stuff.
Why? What makes them worth more?
Better security features, more capabilities specifically for AI and machine learning, just better overall efficiency. It's their premium tech.
So strategically, it lets them make more money, even if chip volumes don't grow as fast.
Exactly. They can boost royalty revenue even if overall shipments are flat or even dip slightly. We saw that in Q4 FYE 24.
What happened then?
Royalty revenue surged 37% year over year. but actual chip shipments were down 10%.
Wow, that's leverage.
It is. And ARM v9 adoption is climbing. It was 15% of royalty revenue in Q3, then jumped to 20% in Q4. So pushing that adoption is vital for their growth story.
They also have that smaller other revenue bit, software tools, support.
Yeah, things like Keel, DS5, software tools, support, training, consulting. It's not insignificant, maybe around $450 million in 2023. It adds value, strengthens the ecosystem.
Okay, so two main income streams. Upfront licenses, ongoing royalties. Seems pretty solid. Now, what about the specific products, the tech?
Well, the core is processor IP,
Uh-huh.
CPU designs.
Like the Cortex series.
Right. You've got Cortex-A, the workhorses in smartphones, also used elsewhere. Cortex-M, super energy efficient, billions of those in IoT devices, embedded systems.
And Cortex-R?
For real-time stuff, like storage controllers. Then there's Cortex-X for the really high-end performance, premium phones, laptops.
And Neoverse, that's for the data center push, right?
Exactly. Neoverse is specifically designed for infrastructure, cloud data centers, networking gear. It's all about performance per watt, challenging the traditional x86 players there.
They do graphics too, Molly.
Yep, Mali and Immortalis brands for graphics and multimedia. And don't forget Ethos, their neural processing units, NPUs, for accelerating AI tasks.
So a broad portfolio. What about the tech behind the cores? System IP, compute subsystems.
Yeah, those are increasingly important. System IP is like the plumbing interconnects, memory controllers helping partners build complex chips efficiently.
Makes sense.
And compute subsystems, or CSS, are like pre-built modules. Pre-integrated, pre-verified chunks of IP like a CPU core or GPU, system IP, all bundled together.
So chip designers can just drop them in. Saves time.
Exactly. Speeds up development hugely. They offer these for IoT, client devices, Neoverse, plus foundational stuff like physical IP, security IP, development tools. It's a whole platform.
Okay, got the tech. Who are the main customers? Where's their dominance?
Mobile. Still their absolute stronghold. Like we said, over 99% of smartphone CPUs in FYE24.
Is that market saturated, though?
Volume growth might be slower, yeah. But they drive value by licensing higher performance IP, which gets higher royalties, plus tablets, laptops. Mobile is still huge for their revenue, around 47% in 2024.
But the focus seems to be shifting, right? Cloud, networking.
Definitely a strategic growth area. Neoverse is gaining real traction. Their market share in cloud reportedly went from 9% to 15% between FY22 and FY24, networking 23% to 28%.
That's solid progress.
And AI infrastructure is just pouring fuel on that fire. High growth potential there, about 10% of revenue in 2024.
What about cars? Automotive.
Huge opportunity. Infotainment, ADS, eventually autonomous driving. Cars are becoming computers on wheels. ARM's got a strong share there, around 40% back in late 2022, about 8% of revenue in 2024.
And IoT, all those billions of connected devices.
Perfectly suited for their low-power Cortex-M and Cortex-A cores. It's a massive, diverse market, about 20% of revenue.
Plus other consumer electronics, TVs, wearables.
Yep, another 15% or so. And AI isn't really a separate market. It cuts across all of these. ARM's energy efficiency is a big plus for AI everywhere.
So overall, they are the leader in semiconductor IP. How do they stack up against others mentioned, like Synopsys or Cadence?
ARM is the clear leader in the IP space itself, way ahead of Synopsys and Cadence in terms of market share for processor IP. They reckon their tech is relevant to a $200 billion total addressable market annually.
And they served about half of that.
Roughly, yeah, about $100 billion TAM. And they capture maybe 2% of that value through their licensing and royalties.
That scale is just immense. 310 billion ARM-based chips shipped since 1990.
Yeah, and they estimate 70% of the world's population uses ARM-based products. It's staggering reach.
So what gives them this edge, this competitive moat?
The ecosystem is probably number one. Over 1,000 licensing partners, Qualcomm, Apple, TSMC, Google Android, supports it deeply. Millions of software developers know ARM.
It's a network effect, right? The more people use it, the more valuable it becomes.
Exactly, self-reinforcing.
Yeah.
Then there are switching costs.
It's hard to move away once you're committed.
Very. Their IP gets baked deep into customer roadmaps, all the software, the tools, optimized for ARM. Switching to something like RSCV, that's a huge effort, huge risk.
And their low power advantage.
Still a key differentiator.
Yeah.
Critical for mobile and IoT, obviously, but increasingly vital for data centers, too, for density and efficiency.
Plus their sheer scale and R&D.
Absolutely. They spent nearly $2 billion on R&D in FYE24. That huge cost gets spread across all their partners, billions of chips. So partners get cutting-edge IP at lower cost and risk than doing it themselves.
And standardization. being the default.
Yeah, they're the de facto standard in mobile, growing and embedded. Simplifies everything, ensures compatibility.
But the research mentioned a challenger, RASCV.
Right. The elephant in the room, maybe? RASCV, open source, royalty-free.
That directly targets ARM's model, doesn't it?
It does. It offers flexibility, customization, no fees. It's gaining momentum. Billions of chips shipped. Big players like NVIDIA, Google, Qualcomm are using it, especially in controllers, accelerators, embedded stuff.
Can it displace ARM in high-end stuff like phones or servers soon?
Unlikely in the near term. The ecosystem isn't as mature for that high-performance space yet, but it could definitely commoditize the lower end, put pressure on ARM's pricing and market share as it matures.
So ARM has to keep innovating.
Constantly. That's why the massive R&D spend. They need to stay ahead technically and leverage that huge ecosystem they've built. It's a real fight shaping up.
Looking ahead then, what's the outlook? For semis, for IP, for ARM?
Generally positive. The semiconductor market is expected to keep growing, maybe 8% CAGR, according to ARM. IP market also growing, maybe 6.7% to 8.5% CAGR.
Driven by
AI everywhere, cloud growth continuing, more chips in cars, IoT expanding, plus just chips getting more complex boost demand for IP.
What about headwinds? Moore's law slowing? Geopolitics?
Definitely potential challenges. Slowing Moore's law makes performance gains harder. Geopolitical tensions, trade wars create uncertainty. And, as we said, RSSCV competition.
So ARM's prospects depend on
Staying ahead technologically, breaking further into cloud, auto, AI, driving that ARM v9 adoption for higher royalties, and defending against RSCV.
and those 2025 U.S. tariffs mentioned. How might they impact ARM even indirectly?
Right, so finished chips were reportedly exempt, but it's fluid. The risk is indirect.
How so?
Tariffs on manufacturing equipment stuff from ASML in the Netherlands. Or Japan could raise chip production costs for ARM's partners. Maybe 32% higher for U.S. production, some estimates say.
And those costs get passed on.
Likely. Which could dampen demand for the end products, hitting ARM's royalty stream. Plus, just general supply chain chaos, uncertainty, delays. That's never good.
And tensions with China, that's a big market.
Huge market for ARM's customers. Tensions could restrict licensing, royalty collection, maybe spur alternatives. National security concerns could also play a role.
So, bottom line on tariffs.
Direct hit on ARM's IP seems unlikely right now. But significant indirect headwinds, yes. Higher costs, unstable supply chains, geopolitical uncertainty in their ecosystem could slow royalty growth at risk.
Okay, that's a really solid grasp on the business side. Let's pivot to management. Who's running the show?
Well, you've got CEO Rene Haas. He's been with ARM since 2013, came from NVIDIA before that. Seemed to have deep industry experience. He led the IPO.
And he's on SoftBank's board, too.
Yes, which highlights those close ties. The chairman is Masayoshi Son, founder and CEO of SoftBank, which owns, well, most of the company, around 90%.
So Sun's influence is massive.
Oh, undoubtedly. Likely has huge sway over strategy. And the CFO is Jason Child, came from Splunk, Amazon, extensive financial background.
So experienced team, but SoftBank's agenda is probably the main driver.
That seems like a very fair assessment. With that kind of ownership, their priorities are likely paramount, which is key for minority shareholders to grasp.
What about how they allocate capital? We talked about that huge R&D spend.
Yeah, that's the absolute priority, reinvestment in R&D. Nearly $2 billion, like 59% of revenue in FYE 24. That's way up from 42% back in 2018.
And management acknowledges this hits profits short term.
Explicitly. They say it's for long-term tech leadership, especially ARM v9 and AI. They also do some acquisitions for tech and talent.
Any dividends? Buybacks?
Not currently. They did before SoftBank bought them in 2016, but not since the re-IPO. Focus is purely on reinvestment right now.
Okay, that R&D focus seems critical. But what about the returns on that investment? The research mentions some weak metrics. ROC.
ROE. Yeah, that's the paradox. Super high gross margins, like 95%, because it's IP. But the return metrics, like return on capital employed, ROCE, have been low recently. TTM Deck 2024 was 5.8%.
How does that compare?
Below the industry average of about 7.2%, and way below ARM's own level of 13% just 2 years prior. Return on equity, ROE, also low at around 4%.
And their cost of capital, WACC?
Estimated around 9.5%. So you have ROCE at 5.8% and WACC at 9.5%.
Which means?
Technically, on an accounting basis, they're currently destroying value. The returns aren't covering the cost of the capital invested.
So that massive R&D spend has to pay off big time down the road to justify this.
Exactly. That's the bet. Future returns need to significantly ramp up to make this intense investment phase worthwhile from a financial perspective.
How shareholder-friendly does management seem? especially for the minority holders.
Their stated focus is clearly long-term growth via reinvestment, not near-term returns like dividends.
What about share-based compensation? SBC.
That jumped significantly after the IPO. It impacts GAAP EPS, so something shareholders watch.
And SoftBank's influence again.
It's paramount.
What?
Their interests drive the bus. That potential chip manufacturing pivot could easily be a SoftBank-driven strategic goal, maybe not perfectly aligned with minority interests.
And executive pay? Alignment.
Hard to say precisely from the provided materials. Didn't have a recent proxy statement with those details. But the core issue remains SoftBank's overwhelming control. It diminishes minority influence significantly.
Makes sense. Okay, let's dive into the numbers. Financial health. Key metrics.
Revenue growth has been strong. Robust, really. FYE 24 up 21%, Q3 FYE 25 up 19%. Q4 FYE 24 was a huge jump, 47%. Guidance is if FYE 25 is aiming for around $4 billion.
So top line looks good. Profitability?
That's where you see the split. Gross profit margins are fantastic, mid-90s, but operating income, there's a big gap between GAAP and non-GAAP.
Because of R&D and SBC.
Exactly. GAAP operating income actually fell in FYE 24, down to just $111 million. But non-GAAP operating income, which excludes that R&D surge in SBC, was $1.4 billion, up 80%.
So non-GAAP looks healthy, but DAP is squeezed.
Right. It shows strong underlying profitability from the core IP business if you exclude those big investment costs. But GAAP tells the full story of current reported profit after all expenses. You need to look at both.
What about the balance sheet? Stability?
Definitely strong, lots of cash, over $2.9 billion as of March 2024. Very little debt, around $271 million. Debt to equity is tiny, like 0.04.
So they're financially stable, low risk of going bust.
Very low solvency risk.
Yeah.
The balance sheet is solid. The question, again, is more about efficient use of that capital, given the low ROC.
And cash flow. Are they generating cash?
Yes, positive free cash flow. Non-GAAP TTM to March 2024 was over $900 million, up 50% year over year.
But how does that stack up against the valuation?
That's where it looks stretched. Price to free cash flow was super high, over 200 based on TTM Q4 2024. Free cash flow yield very low, like 0.5%.
So the current cash flow alone doesn't seem to support the stock price.
Not really. The valuation is clearly pricing in substantial future growth in that cash flow. Need to assess if current levels are sustainable long term.
Okay, finally on financials. Valuation versus peers. Synopsis, cadence. How does ARM compare?
It trades at a massive premium, really elevated multiples.
Like P ratio.
TTM PE around 162. Forward PE still very high, maybe 127 or lower, depending on estimates. Back in late 2023, it was over 370x compared to the industry average.
Wow. What about price to sales?
PFs also extremely high, around 35. Peers like Synopsys and Cadence were more like 11-15 back in March 2025.
Yeah.
The U.S. semiconductor average was closer to 3.
So way more expensive based on sales.
EBITDA.
Also sky high. TTM Q4 2024 is around 580.
And return metrics lag.
Yeah, ROCE at 5.8% is below the industry average of 7.2%.
So this huge premium implies
What? Massive expectations from the market. Huge growth baked in, driven by AI, continued mobile strength, market share gains. Justification depends entirely on them delivering consistently on all that. Represents significant risk for value investors then.
absolutely a very large premium with little room for error.
That paints a very clear financial picture. All right, let's take a quick break. When we come back, we'll get into market sentiment, ownership structure, and wrap up with the key risks. Welcome back to the Deep Dive. We're digging into ARM Holdings. Before the break, we covered the business, management, and financials. Now, how is the market actually feeling about ARM stock? What's the sentiment?
It's really a mix. There's definitely a lot of enthusiasm, particularly around AI. People see ARM as being right at the center of that boom. But there's also significant concern about that really high valuation we just talked about.
So excitement versus sticker shock.
Pretty much. The stock's been volatile since the IPO back in September 2023. Big gains initially, then a pretty hefty correction, maybe 30% off its peak, before bouncing back recently. The 52-week range is wide, $80 up to nearly $189.
And the narrative driving it.
That ARM is this critical enabler for the whole semiconductor industry, especially for AI. That fuels high expectations.
But the concerns linger. Valuation, tariffs, competition.
Absolutely. And it's interesting, the stock often reacts negatively to earnings, even when they beat estimates.
Meaning expectations are just incredibly high.
Sky high. Hard to impress the market when so much good news is already baked in. Technical indicators are kind of mixed too.
What are the analysts saying overall? Price targets?
Mostly positive ratings. Strong buy or moderate buy is the general
But
consensus.
the targets themselves?
All over the place. A really wide dispersion. The average might be around $170, $180, suggesting decent upside. But highs go up to $200, $225, while lows are down at $73, $140.
That's a huge range. Any recent changes?
Yeah, some analysts have trimmed targets recently. Morgan Stanley, UBS, citing things like litigation risks, maybe slower ARM-v9 adoption than hoped.
What about earnings forecasts? Still strong.
Projections look pretty robust. EPS growth expected to be strong over the next few years, maybe a CAGR around 28% from 2024 to 2027.
So analysts are generally bullish on the growth story.
Seems like it. Driven by AI, market share gains, those non-GAAP numbers. But that wide target range and the recent caution shows the uncertainty.
It feels like analysts are more growth-focused than value-disciplined here.
It often seems that way with these high-growth tech stories. They might be underestimating the valuation risk. There's reportedly a big gap between average targets and some DCF intrinsic value estimates.
How has recent news impacted the stock? AI development.
Generally positive catalysts. Things like the rumored Stargate AI project with SoftBank, OpenAI, Oracle, reports of ARM developing its own AI chips for 2025, product launches using ARM-based AI. That stuff helps sentiment.
And bad news. Tariffs.
Yeah, tariff concerns definitely cast a shadow, create uncertainty. Wells Fargo flagged those risks.
And earnings reactions we mentioned, often negative even on beats.
Right, the stock is super sensitive. The reaction to the FYE25 guidance back in May 2024 was negative, even though it projected around 20% growth. High bar.
What about that potential strategy shift into making chips? How did the market react?
Caused a lot of volatility. The stock plunged like 18% when those reports first surfaced. Shows how sensitive the market is to any changes in that core IP licensing model.
What about short sellers? Is there much short interest?
As of mid-April 2025, about 16.5 million shares short. It's relatively low as a percentage of total shares because SoftBank owns so much, but as a percentage of the float, it's more significant. Days to cover around 2.3.
Suggests some persistent bearishness, likely on valuation.
Yeah, that seems the most likely driver for the shorts. Valuation concerns.
And the options market, active.
Very active. Reflects the volatility expectations, lots of volume around certain strike prices, especially ahead of earnings. You see demand for both puts downside protection and calls bullish bets.
So the options market is pricing in big moves.
Definitely. Implied volatility ahead of the May 7th earnings suggested a 10.4% move was priced in. Shows a division. Bulls on growth versus bears on valuation. Lots of uncertainty being actively traded.
Okay, let's shift to ownership. We know SoftBank is key. How dominant are they?
Overwhelmingly dominant. They own somewhere between 88% and 90% after the IPO. They bought ARM in 2016, then bought back the Vision Fund stake before relisting.
So they have effective control, board, strategy.
Total effective control. Masayoshi's son, as chair, likely has immense influence on decisions, like that potential chip manufacturing idea. This is absolutely critical for any minority investor to understand.
With SoftBank holding so much, the public float must be tiny.
Extremely low. Maybe only 10% of the 1.05 billion shares are actually available for public trading.
And institutions own a chunk of that float.
Yeah, institutional ownership is maybe 6–7% of the total shares, but that represents around 58% of the tradable float. So they have amplified influence on daily trading.
Who are the big institutional holders besides SoftBank?
The list includes names like DZ Bank, Goldman Sachs, Morgan Stanley, BlackRock. Even Google's parent Alphabet holds some. 881 institutions reportedly held shares.
What does that low float mean for the stock?
High volatility. Small trades can move the price significantly. And the big risk is SoftBank potentially selling down some of its massive stake. That would be a major market event, creating a supply overhang.
What about insiders besides SoftBank? Management holdings?
Reported at basically 0.00%. Very low.
Any recent buying or selling by them?
No open market buys or sells reported in the last 12 months, excluding things related to the IPO or compensation vesting, so not much signal there. Focus remains squarely on SoftBank.
And corporate governance, given SoftBank's control.
ARM is classified as a controlled company because of SoftBank's stake.
Meaning?
They can be exempt from certain NASDAQ rules, like needing a majority of independent directors. SoftBank controls the board. Sun is chair. Haas is on SoftBank's board. Minority shareholders have very limited influence.
Reporting standards, they're UK incorporated but NASDAQ listed.
Right. They file as a foreign private issuer, FPI, with the SEC. So they use Form 20F for annual reports, Form 6K for earnings, slightly different from U.S. companies.
So the main governance takeaway is?
Concentration of control with SoftBank. Provides stability, maybe, but limits minority influence and raises risks around decisions favoring the parent. Investors just have to be comfortable with that.
Okay, very clear picture on ownership. Now, let's pull it all together with risks. The research had a SWOT analysis. What are the key threats?
The biggest long-term threat is probably competition, specifically from RISC-V.
We touched on that. Open standard, royalty-free.
Directly undermines ARM-M's model. It's gaining traction, big players are adopting it. While it might not displace ARM at the high end immediately, it could seriously pressure pricing and share over time, especially if its ecosystem matures. ARM's defense is constant innovation and leveraging its existing ecosystem strength.
What else? Valuation risk.
Huge risk. The valuation is extremely high by almost any measure compared to peers or history. It prices in near-perfect execution, massive growth across AI, cloud, auto, and successfully fending off threats.
No margin of safety.
Very little. Any stumble slower ARMv9 adoption, market share slips, macro issues, stronger competition could trigger a sharp correction.
Customer concentration.
Right.
Relying on a few big players.
Yes, the company acknowledges this. Losing or seeing reduced business from a major licensee like Apple, Qualcomm, or a big cloud provider would hurt significantly. Ongoing risk of pricing pressure, too.
Geopolitical risks. Tariffs.
Still a factor. U.S.-China tensions, those 2025 tariffs impacting partners. It creates uncertainty and potential demand dampening, even if ARM isn't directly taxed. China market access is also a risk.
What about that potential strategic pivot into making chips?
That's a major uncertainty now. Huge execution risks, manufacturing, supply chain, sales. Financial risk, capital intensive, likely lower margins initially. Competitive risks, competing with your own customers. Success isn't guaranteed, and failure could damage the core business and ecosystem.
And SoftBank's influence has a risk.
Absolutely. Governance risk decisions might prioritize SoftBank. Strategic risk-pushing initiatives like chip making. And overhang risk, the potential for them to sell large blocks of stock in the future could disrupt the market.
Okay, bringing this all home, synthesizing everything, what's the bottom line, especially from a value perspective?
Okay, summing up. ARM has clear strengths, dominant market position, scalable IP model, big opportunities in AI, cloud, auto. That's the bull case.
But the concerns...
Significant concerns for a value investor. SoftBank's control, the currently low ROCE despite high R&D spend, that extremely high valuation, the RSCV threat long-term, and those geopolitical clouds.
What about intrinsic value estimates? The research mentioned DCF.
Yeah, some analysts' DCF models reported in the research suggested intrinsic values significantly lower than the current market price, maybe in the 35 to 61.1 range, compared to the $123 price around early May 2025. That suggests significant overvaluation according to those models, but DCFs are very sensitive to assumptions, of course.
So, using that classic value investing lens, Buffett's questions. Understandable business, moat, management, economics, price?
Let's see. Business, yes. Understandable IP licensing. Moat, strong, but facing a growing challenge. RACV. Management, experienced but alignment with minority holders is questionable due to SoftBank, and capital allocation effectiveness, ROCE, is currently weak. Economics. High gross margins, yes, but GAAP profitability and returns are currently compressed by investment. Price. Clearly fails the sensible purchase price test right now. No margin of safety.
So the final assessment from that value standpoint.
Despite the quality of the tech and market position, the stock looks significantly overvalued at $123. The risk-reward seems unattractive for value investors at this level.
What would need to change?
A substantial price decline or concrete proof of highly profitable growth kicking in and much better capital efficiency, shown by rising ROCE. Things to watch closely are ARMv9 adoption, ROCE trends, RACV's progress, and SoftBank's actions.
That's a really thorough, insightful breakdown. ARM Holdings, clearly a fascinating, pivotal company in tech, but definitely comes with a complex and perhaps challenging valuation story right now.
Absolutely. So what does this all mean for the future of computing and maybe your own investment thinking? We want to leave you with a final thought to chew on.
Yeah, here's something to ponder. Given the rise of these open-source hardware initiatives like RISC-V and ARM's current really high premium valuation, how might that balance of power in the semiconductor IP world actually shift over the next decade? And what unforeseen opportunities or maybe disruptions might pop up because of that shift?
It's definitely something worth thinking about as you continue to explore the sources we've mentioned there in the description and form your own informed opinions.
And if you found this deep dive helpful, please consider subscribing to the Stock Analytics AI YouTube channel. We do these regularly.
And just a reminder, This discussion was for informational purposes only. It's not investment advice.
Always do your own thorough research. Consult with a qualified financial advisor before making any investment decisions. While AI was used to help compile and analyze some info, the views here are ours.